Scalar just lost almost 20% in one night. The print itself was not bad. Revenue beat, earnings beat, billings grew 23%, operating margin hit a record 23%. So why did the stock get cut by a fifth overnight? Because Zscaler did the one thing every high growth software company tries to avoid. They told the market the growth era is ending, and then they cut the free cash flow margin too. Let me walk you through what actually broke. First, the setup. Going into this print, Zscaler had ripped over 13% in the week leading up to earnings. The market was expecting a beat and a raise. The bar was high. Heading in, the stock was trading at about 47 times forward earnings, priced for sustained growth in the low 20s or better. Anything less would force a repricing. The headline numbers did not disappoint. Revenue came in at $873 million, up 25% year over year, beating the $855 million estimate by 18 million. Total annual recurring revenue hit $3.61 billion, also up 25%. Earnings per share was $1.13, well ahead of the dollar consensus. Billings grew 23%. Remaining performance obligations grew 30%. By every measure you would normally use to grade a software quarter, this was a beat. And then management issued forward guidance. That is when the stock fell off a cliff. The after hours move from roughly 184 down to 149 was not a reaction to what just happened. It was a reaction to what they told us about next year. So let us walk through what actually broke the bull case. There were two bombs. Bomb number one, management issued preliminary fiscal 2027 guidance calling for annual recurring revenue growth of 16 to 17%, revenue growth of 16 to 17%. This was the number that broke the stock. To put that in context, this fiscal year is tracking at roughly 24 to 25% growth. The new guide implies a deceleration of 800 to 900 basis points in a single year. That is not a tweak, that is a regime change. When a high growth software stock trades at 47 times forward earnings, the market is paying a premium for sustained growth in the 20s. The moment growth resets to the mid-teens, the entire valuation framework changes. A 40 times multiple on 25% growth gives you a price to earnings growth ratio of 1.3. That is rich but defensible for a category leader. A 40 times multiple on 16% growth gives you a price to earnings growth ratio of 2.5. That is no longer rich. That is expensive. The market did the math in real time. If 16 to 17% is the new normal, the multiple needs to compress from the 40s down to the low 30s. That implies further downside even from the after hours low. The first bomb alone explains about 70% of the move. Bomb number two, free cash flow margin collapsed. This quarter's Zscaler did 15.2% free cash flow margin, down from 20.2% in the year ago quarter. A 470 basis point deterioration. Worse, management cut full year free cash flow margin guidance from a range of 26.5 to 27% down to a range of 22.8 to 23.3%. Then they confirmed that 22 to 23% is also the right level for next year. This breaks what software investors call the rule of 50. Scalar used to be a rule of 50 company. 25% growth plus 27% free cash flow margin equals 52. Premium tier. After this guide, it becomes a rule of 40 company. 16% growth plus 22% free cash flow margin equals 38. Mid-tier at best. Three drivers are doing the damage. 1. Deferred revenue went from a positive $90 million swing a year ago to a negative $66 million swing this quarter. The shift to consumption-based pricing means the company collects cash slower than it recognizes revenue. 2. Sales commissions grew 32% against revenue growth of 25%. That is a sales efficiency red flag. 3. Capital expenditures are guided higher next year. The free cash flow story is structurally broken. Now the bear case in one breath. Organic net new annual recurring revenue, the single most important number in the report, grew only 14% year over year this quarter. Full year organic growth is tracking at 9.5%. Below the headline, way below, net revenue retention sits at 115%, the lowest among the big three cybersecurity names. Palo Alto runs around 119. CrowdStrike sits between 115 and 120. Two sales leaders departed at the end of the quarter. The chief executive acknowledged the new logo engine has not been performing well. None of these issues are temporary, they are structural, and they all showed up at the same time. But there is a counter argument worth taking seriously. The chief executive disclosed on the call something that did not make it into the guide. Demand for zero trust security has spiked unexpectedly because frontier artificial intelligence models are now discovering vulnerabilities at machine speed. Customers are calling in panic. The chief executive used the phrase, "We have never seen so many inbound calls come in so quickly." That demand surge is real and it is not in the forward guide. The sales leadership transition is also temporary. One replacement has already been hired internally. The second hire is in late stage recruiting. Plus, the company is rolling out a four-part plan for next year focused on new logo acquisition, more sales coverage in the mid-market, new incentive programs for the channel, global system integrator partnerships, a renewed focus from the major accounts team. The bull case says this guide is sandbagged. If artificial intelligence demand converts to actual contracts in the back half of next year, the company could come in at 20% growth or higher. That would restore the multiple. Compare this to Palo Alto Networks for a moment. Palo Alto runs a faster growth rate, a wider platform, a better operating margin, and dramatically better free cash flow conversion. Palo Alto runs around 37 to 39% free cash flow margin. Zscaler will be lucky to hit 23% next year. That is a 15-point gap on cash conversion alone. Palo Alto also runs a higher net revenue retention, a broader product portfolio, and a clean enterprise platformization story that the market already understands. Zscaler used to differentiate on cloud-native architecture and zero trust purity. Those advantages still exist, but they no longer translate into faster growth than the competition. When you can buy a faster growing, better executing, higher cash flow company at a similar multiple, the case for Zscaler weakens substantially. Palo Alto is winning the platform consolidation race at the high end. So the verdict, is this a buy on weakness? At 149 in after hours, the Zscaler trades at roughly 40 times forward earnings on the new 16 to 17% growth profile. That is still expensive. Compare this to a real dislocation pattern. ServiceNow sold off 14% earlier this year on misunderstood noise about a margin headwind that turned out to be temporary. Growth stayed at 22%, moat intact. That was a buy. Zscaler is the opposite. Growth has structurally decelerated. Cash flow quality has deteriorated. Sales leadership is in transition. The sell-off is justified, not overdone. Three scenarios would change the verdict. Scenario 1. The stock drops another 15 to 20% into the 120s. That compresses the multiple enough to absorb the growth reset. Scenario 2. Next quarter shows organic net new annual recurring revenue stabilizing above 10% growth. That signals the engine is not broken, just transitioning. Scenario 3. The artificial intelligence demand surge converts to actual bookings in the back half of next year. That would restore growth above the sandbagged guide until at least one of those plays out. This is a name to watch, not a name to own. If you found this breakdown useful, hit subscribe. New stock reviews every week. Talk to you in the next one.